sinokor strategy. In this presentation, I shall be talking about a story of some good news and some benefits to some people of this war, which is generally causing problems to most people in the region and globally also. But there is some good news for some people, and this is the story about that. It's about the action taken by some investors based on the probability that there's a 65% chance that this war would happen in 2025. I mean, the information of 2025 that there's a 65% chance that this war would happen, and it happened in 2026. And this is the story about how some people benefited from making a decision and investments regarding this. So we'll be examining one of the most remarkable case studies in modern maritime history, how market intelligence from 2025 pointed to a potential Iran conflict in 2026, and how sinokor Maritime positioned itself to capture over $1 billion in value when those forecasts materialized. We'll cover three critical areas. First, what did intelligence agencies, think tanks, and market analysts actually say in 2025 about the probability of the war with Iran? Second, how did sinokor position its assets in late 2025 and early 2026? And third, who is Ga Hyung Chung, the mastermind behind these strategic moves? This isn't just a story about lucky timing. It's a textbook example of how geopolitical intelligence, when properly analyzed and acted upon, can create extraordinary value. In a way, we call this value investing. By the end of this presentation, you'll understand the specific indicators that were available, the probability frameworks that were used, and the strategic decisions that separated the winners from the losers in the market. So let's continue with the story. Before we proceed, I must provide important disclaimers regarding the content of this presentation. First, information accuracy. This presentation synthesizes data from multiple sources, including public intelligence assessments, think tank reports, commercial shipping intelligence, regulatory filings, and media reports. While every effort has been made to ensure accuracy, some information may be incomplete, outdated, or subject to interpretation. Geopolitical intelligence, by its nature, involves uncertainty and estimation. So when we give probability assessments like 55 to 75%, they represent analytical judgments, not factual certainties. Specific figures regarding vessel values, charter rates, and financial transactions are based on available market data but may vary by source or timing. Second, forward-looking statements, any projections about future VLCC rates, war duration, regulatory outcomes, or strategic scenarios represent hypothetical analysis, not predictions. Actual outcomes may differ materially due to unforeseen events, policy changes, market dynamics, or black swan occurrences. The scenario analysis presented is for illustrative purposes only and should not be relied upon as forecasting. Third, not financial, legal, or investment advice. This presentation is for educational and informational purposes only. We are teaching value investing, and this is one of the cases. It does not constitute a recommendation to buy, sell, or hold any securities, vessels, or assets. It does not provide any legal guidance on sanctions, compliance, antitrust matters, or contractual obligations. Any investment or strategic decisions should be made in consultation with qualified professional advisors who understand your specific circumstances. This is true that if you are doing business, in some cases, the contracts have to be checked by official, legit, legal people to be applicable in courts, and also regulators when you're doing some business. Like if you're making agreements or you're dealing with securities, to be applicable and valid in court, they have to be checked by official, registered, certified professionals, also of a certain level, not just anyone. So this is an important thing to note. In the days of AI, you can get a lot of stuff done, but that does not mean it will apply legally when it comes to the courts. So be aware of that. Fourth, privacy and individual profiles. Information about people and individuals in this presentation is derived from public sources, industry reports, and media coverage. Some details may be speculative or based on limited public information. No private or confidential information has been used. Individuals mentioned have not endorsed this presentation. Fifth, dynamic events. Geopolitical situations, market conditions, and regulatory environments evolve rapidly. Information is accurate as of today when this presentation is made, which is March 26th of March 2026, and may become outdated quickly. Users should verify current status through real-time sources before making decisions. Sixth, no endorsement is implied. Mention of specific companies, individuals, or sources does not constitute endorsement of their views, practices, or accuracy. Similarly, the critical analysis of strategic decisions does not imply any wrongdoing without any evidence. By continuing with this presentation, you acknowledge these limitations and agree to use this information responsibly, verify critical claims independently, and consult appropriate professionals for decisions affecting financial, legal, or strategic outcomes. Thank you for your understanding, and let's proceed with this content. Oh, by the way, if you did not understand this, don't continue with this presentation, and please don't make assumptions and make claims about referring this presentation in a manner where your assumptions are forwarded saying that we said so. That's not a good idea. Let's start with the bottom line. Throughout 2025, multiple independent intelligence... Okay, we're going to cut here and then we're going to cut the last part. The last item has to be cut, about when we continue with the nose and all, and the noise. Let's start with the bottom line. Throughout 2025, multiple independent intelligence sources assessed the probability of a major US-Israel military operation against Iran as moderate to high. The consensus range was 55 to 75%, with a central estimate around 65%. This wasn't a vague warning. Analysts identified specific time windows. The primary window was October to November 2025, based on factors like optimal weather conditions, pre-midterm US political timing, and the expected deployment of Israel's Iron Beam defense system. When that window passed without conflict, analysts identified a secondary peak in January 2026. The actual conflict began on February 28, 2026. While this was slightly later than the primary forecast window, it remained well within the broader October 25 to March 2026 timeframe that most serious assessments had identified. What's critical to understand is that this intelligence didn't predict the war with certainty. A 65% probability means there was still a 35% chance it wouldn't happen. But for strategic planners and risk managers, a 2 in 3 chance of a major political event is absolutely significant enough to warrant contingency planning and strategic positioning. Let's examine the specific assessments from the academic and strategic research institutions. The most sophisticated analysis came from Tui Serkani at the University of Tehran in October 2025. This wasn't a simple guess. The researcher developed an 11-variable convergence framework examining factors like operational precedent from a June 2025 12-day conflict, UN sanctions snapback that occurred in late September, IAEA verification collapse with 440 kilograms of enriched uranium unaccounted for, and complete diplomatic deadlock between zero enrichment demands and NPT rights claims. What made this analysis particularly valuable was its methodology. Rather than imply adding up risk factors, the researcher used multiplicative convergence, recognizing that when multiple independent variables all point to the same direction, the probability compounds rather than simply adds. This produced the 55 to 75% range with a 65% central estimate. The New Lines Institute, a Washington-based think tank, reached a similar 65% probability in September 2025, focusing on the Israeli campaign momentum following earlier strikes, continued US political and military support, and evolving regional proxy dynamics that were constraining Iran's retaliation options. By December 2025, Spatial Eurasia assessed a Phase 2 conflict as highly probable, citing Iran's advancement to 90% uranium enrichment and what they described as a closed diplomatic window. These independent assessments from different institutions using different methodologies all converged on the same conclusion: elevated risk of military action. The U.S. intelligence community provided its own warnings throughout 2025. The Office of the Director of National Intelligence, the acronym ODNI, released its annual threat assessment in March 2025. This unclassified document stated that Iran was pursuing a survival-focused nuclear posture and critically assessed the risk of escalation as significant. The report highlighted a specific and alarming intelligence gap: 440 kg of uranium enriched to 60% could not be accounted for. To put this in perspective, 60% enrichment is just one step away from weapons grade 90%. This wasn't low enriched uranium for civilian power reactors. This was material that could be quickly converted to weapons grade with minimal additional processing. The Defense Intelligence Agency provided additional context later in 2025. They assessed that while Iran remained capable of retaliatory strikes through its proxy networks and missile forces, the country was increasingly constrained by regional realignments. Specifically, the DIA noted that Saudi-Pakistan Defense Pact had been signed, which created a counterweight to Iranian influence. They also highlighted the US-Qatar security guarantee, which protected critical Gulf infrastructure and limited Iran's ability to use asymmetric retaliation effectively. These assessments weren't predicting inevitable war. They were identifying a deteriorating situation where diplomatic options were closing, nuclear thresholds were being crossed, and the risk of miscalculation or preventive action was rising significantly. While government and academic assessments were important, commercial market intelligence provided equally critical signals. BIMCO, the world's largest shipping association, issued warnings in June 2025 that the threat to commercial shipping was rising. They specifically noted that Iran could employ anti-ship missiles and drones against commercial vessels if the conflict erupted. The market responded to these warnings. War risk insurance premiums for transits through the Strait of Hormuz increased by more than 60% by mid-2025. This wasn't a theoretical risk anymore. Insurance underwriters were putting real money behind their assessments, charging significantly higher premiums to vessels transiting these waters. Argus Media, a leading energy market intelligence firm, provided nuanced analysis in December 2024. They noted that the VLCC market was facing downside risk from weak demand and oversupply. However, they specifically flagged that an Iran conflict would completely reverse this trend. This insight was crucial. It meant that tanker positioning could serve as a strategic hedge. If you owned tankers and positioned them correctly, you could profit from the conflict even if the baseline market was weak. By February 2026, just before the war started, Bloomberg was reporting that tanker rates could surge to decade highs if Iran's risk materialized. The market was clearly pricing in an elevated probability of escalation. These weren't hindsight observations. These were real-time signals available to anyone paying attention to commercial shipping intelligence. The most sophisticated analytical framework came from the 11-variable convergence model developed in October 2025. Let me walk you through each variable because understanding this framework is essential for future intelligence assessment. First, operational precedent. In June 2025, there had been a 12-day conflict that demonstrated the feasibility of military action and established operational templates. Second, sanctions snapback. U.S. restrictions were reimposed on September 28 to 29, 2025, creating legal and economic pressure. Third, verification collapse. The IEA was denied access to facilities and 440 kg of enriched uranium could not be accounted for. Fourth, diplomatic deadlock. Positions had hardened into zero-sum demands, zero enrichment versus NPT rights with no middle ground. Fifth, regeneration timeline. Intelligence suggested Iran could restore its missile capacity in 6 to 12 months, creating a narrowing window for preventive action. Sixth, regional constraints. Saudi-Pakistan pacts and US-Qatar guarantees limited Iran's retaliation options, making military action less risky. Seventh, defense improvements. Israel's Iron Beam system was expected to be deployed between December 2025 and February 2026, providing enhanced protection. Eighth, political calendar. The pre-midterm US political environment and optimal October to November weather created a favorable window. Ninth, intelligence gaps. Uncertainty about concealed transporter ejector launchers and uranium locations created pressure to act before capabilities dispersed further. 10th, leadership psychology. Unpredictable decision making under pressure from both Iranian and US leadership increased miscalculation risk. 11th, black swan risks. Terrorism, Taiwan crisis, or internal Iranian upheaval could redirect priorities or trigger escalation. The critical insight is that these variables didn't just add up, they multiplied. When 11 independent factors all point toward conflict, the probability compounds. This is why the assessment reached 65% rather than a lower figure. Timing was everything, and the 2025 forecasts were remarkably specific about temporal windows. The primary window was identified as October to November 2025. With a cumulative probability of 55 to 60%, this timing was based on several factors: optimal weather conditions in the Persian Gulf, the pre-midterm US political calendar, and the expected operational readiness of Israeli defense systems. When October and November passed without conflict, the probability didn't disappear. December showed a lower 10 to 15% probability, representing a pause for the holidays and diplomatic efforts. January 2026 emerged as a secondary peak with a 15 to 25% probability. This was partly based on the expected deployment of Israel's Iron Beam defense system, which would provide enhanced protection against Iranian retaliation. February to March 2026 showed a declining 5 to 10% probability as the window was considered to be closing. Beyond March, the baseline probability dropped to 5 to 10% because Iran's regeneration timeline would begin to erode the military's advantage. The actual conflict began on February 28, 2026. This was at the tail end of the forecast window, but still within the time frame that serious analysts had identified. The key insight is that probability isn't static. It evolves as indicators change, windows open and close, and conditions shift. For strategic planners, this temporal distribution was invaluable. It allowed for phased positioning, initial preparations in the primary window, maintained readiness through the secondary peak, and contingency plans for the tail risk beyond March. While intelligence agencies were publishing assessments, commercial markets were sending their own signals. Let's examine three critical market indicators that were available in late 2025. First, VLCC positioning. Sinokor's acquisition of 35 very large crude carriers and their positioning of 6 tankers inside the Persian Gulf in late 2025 was noticed by the market analysts. Some interpreted this as a strategic hedging based on geopolitical risk assessment. These weren't random purchases. This was concentrated buying that absorbed 78% of the available market liquidity. The positioning of 6 empty tankers inside the Persian Gulf in late January 2026, just 33 days before the war started, was particularly noteworthy. These vessels crossed the Strait of Hormuz and positioned themselves inside the Gulf while it was still possible to do so without extreme risk. Second, insurance premiums. War risk insurance for the Hormuz transits increased by more than 60% by mid-2025. Insurance markets are typically efficient at pricing risks. When underwriters demand 60% higher premiums, they're putting real capital behind their risk assessment. This wasn't speculation, this was priced risk. Third, the freight rates. Shanghai to Jebel Ali container rates increased 55% month over month in June 2025 on escalation fears. This was an early sign that commercial shippers were already adjusting their behavior on the perceived risk. These market signals were available to anyone monitoring the shipping intelligence. They provided real-time confirmation of the geopolitical risk assessments being published by think tanks and intelligence agencies. In June 2025, Jacob Larson, the security head at BIMCO, issued specific risk mitigation advice to the shipping industry. His recommendations were clear and actionable. First, merchant ships should consider reducing exposure by routing away from the Iranian coast. This wasn't a suggestion to avoid the region entirely, which would have been economically impossible for many trades. Instead, it was advised to maximize distance from Iranian territorial waters and areas where anti-ship missiles or drones could be launched. Second, maintain close contact with naval forces. This meant coordinating with the US Fifth Fleet, combined maritime forces, and other naval assets operating in the region. Ships that maintained this contact could receive real-time threat warnings and potentially benefit from naval protection. Third, increase vigilance. This meant enhanced watchstanding, additional lookouts, activated radar systems, and prepared emergency procedures. It also meant training crews on damage control and abandoned ship procedures specific to missile or drone attacks. Fourth, consider exposure reduction. For ship owners with flexibility, this meant reducing the number of vessels transiting high-risk areas, accelerating or delaying voyages to minimize time in danger zones, and potentially accepting higher costs for safer routing. This advice was published in June 2026, 8 months before the conflict began. It was available to every shipping company in the world. The question wasn't whether risk existed, the question was how each company would respond to that risk. Some companies like Sinokor saw the opportunity. They positioned assets to profit from the risk. Others reduced exposure to minimize potential losses. Both strategies were rational responses to the same intelligence. Despite sophisticated analysis, 2025 intelligence assessments could not predict the exact timing of the conflict. Understanding why is crucial for setting realistic expectations about what intelligence can and cannot do. First, leadership psychology. The decision-making processes of both Iranian Supreme Leader Khamenei and US leadership were inherently unpredictable. Khamenei's health and succession dynamics created uncertainty about Iranian red lines and risk tolerance. Similarly, the US decision calculus involved multiple stakeholders with different priorities and risk appetites. Second, intelligence gaps. Despite extensive collection efforts, critical information remained unknown. The size and location of Iran's concealed mobile launcher reserves were uncertain. These gaps meant that military planners couldn't be certain about the completeness of strike plans or the effectiveness of Iranian retaliation. Third, the black swan vulnerability. Unpredictable events like terrorism, a Taiwan crisis, or internal Iranian upheaval could have redirected priorities or triggered unexpected escalation. These events, by definition, cannot be forecast with precision. Fourth, diplomatic wildcards. Analysts assess a 3 to 8% probability of an unexpected diplomatic breakthrough. While low, this possibility meant that conflict was inevitable. Last-minute negotiations, third-party mediation, or face-saving compromises could have averted war. Fifth, great power uncertainty. The thresholds for Russian or Chinese intervention remained opaque. Would they provide advanced weapons to Iran? Would they veto US resolutions? Would they intervene directly? These uncertainties affected the risk calculation for all parties. The lesson isn't that intelligence failed. The lesson is that intelligence provides probabilities, not certainties. A 65% probability assessment is valuable even when it can't predict exact timing. It allows for preparation, positioning, and risk management. With the benefit of hindsight, we can now assess how accurate the 2025 forecasts were. The results are remarkably strong across multiple dimensions. First, the probability range. The central estimate of 65% proved directionally correct. The war did occur, validating the moderate to high risk assessment. Importantly, the forecast never claimed certainty. They provided a probability range and the outcome fell within that range. Second, the timing window. The conflict began on 28th of Feb 2026, which was within the broader October to March 2026 window that analysts had identified. While it was at the later end of the range, it was still within the window. This timing accuracy is significant for strategic planning purposes. Third, the operational concept. The forecast anticipated US-Israel joint strikes focusing on nuclear and missile infrastructure, aligned with what the analysts called a persistent denial framework. This is essentially what occurred in Operation Epic Fury, which began on February 28 and included strikes on Iranian nuclear facilities and missile sites. Fourth, the market impact. This is where forecasts actually underestimated the outcome. VLCC rates didn't just increase, they tripled, rising from approximately $35,000 per day to $108,000 per day, which is a 209% increase. Storage rates reached 500,000 per day, exceeding even the bullish forecasts. The market reaction was more severe than most analysts had predicted. Fifth, regional containment. The forecast anticipated that Iranian retaliation would be constrained by regional realignments, the Saudi-Pakistan pacts and the US-Qatar guarantees. This proved accurate. While Iran did attempt some proxy attacks, the escalation was limited, and Gulf states successfully hedged their positions. Overall, the 2025 intelligence assessments demonstrated strong predictive validity. They correctly identified elevated risk, approximate timing, operational concepts, and regional dynamics. The main underestimation was the magnitude of market impact, which actually benefited those who had positioned for the risk to their benefit. What lessons can we extract from this case study for future intelligence assessment? I've identified 5 critical takeaways. First, convergence analysis works. When multiple independent variables all point in the same direction, probability assessments gain significant credibility. The 11 variable framework wasn't just a list of risks, it was a systematic analysis of how different factors reinforced each other. Even when the exact timing remains uncertain, convergence provides confidence in the overall direction. Second, market intelligence serves as a leading indicator. Tanker positioning data, insurance premium changes, and freight rate movements can signal institutional expectations before public intelligence assessments are released. Markets aggregate information from thousands of participants, each with their own intelligence sources and risk assessments. Watching these signals provides early warning. Third, the robust to initiation framework is valuable. Rather than focusing on who strikes first, assess outcomes regardless of initiation. Whether the US strikes first or Iran takes some provocative action, the likely outcomes may be similar. This framework clarifies strategic realities beyond tactical sequencing. Fourth, epistemic humility matters. The 2025 forecasts explicitly acknowledged a 25 to 45% uncertainty space. They didn't claim to know everything. This honesty preserved analytical credibility when events unfolded. Overconfidence destroys credibility. Acknowledging uncertainty builds trust. Fifth, temporal windows are critical. Probability isn't static. It decays outside specified time frames. The October to November 2025 window had different probability than the post-March 2026. Forecasts must be continuously updated as indicators evolve. Windows open and close and the conditions shift. These takeaways aren't just theoretical, they are practical tools for anyone involved in strategic planning, risk management, or investment decisions in geopolitically sensitive sectors. Let me bring this section to a close with the bottom line. The 2025 market intelligence did not predict the Iran war with certainty. No serious analysts claimed that, but it did identify a structurally elevated risk window with 55 to 75% probability. A clear time window from the October 25 to March 2026 and specific indicators to monitor. This intelligence was publicly available. It was published in think tank reports, intelligence community assessments, commercial shipping advisories, and market analysis. Any shipping company, investor, or strategic planner could have accessed this information. The critical question isn't whether the intelligence was accurate. The critical question is who acted on it. Sinokor acted. They acquired 35 VLCCs, absorbing 78% of the available market liquidity. They positioned 6 empty tankers inside the Persian Gulf in late January 2026. Incidentally, it was 33 days before the war started. They filed an MSC partnership deal on the 25th of February 2026. This incidentally was 3 days just before the conflict. The result is they had 1.2 billion positive value creation in just 6 weeks. The VLCC rates increased by 209%. Storage rates reached $500,000 per day. Fleet values jumped by $20 million per vessel. Other companies had the same intelligence, most did nothing. Some reduced exposure. A few, like Sinokor, saw the opportunity and acted decisively. This is the difference between having intelligence and using intelligence. The information was available, the probability was clear, the window was identified. The question for all is, when the next opportunity arises, will we act? Now let's shift from the intelligence picture to the strategic response. This section examines Sinokor's positioning in detail, looking at the specific timeline of events, the value creation that resulted. The timeline tells a remarkable story. In late January 2026, Sinokor positioned 6 empty, very large crude carriers inside the Persian Gulf. This was 33 days before the Iran war started. These vessels crossed the Strait of Hormuz and positioned themselves inside the Gulf while it was possible to do so without extreme risk. On 25th of Feb, Sinokor and MSC filed regulatory documents for MSC's acquisition of a 50% stake in Sinokor Maritime. This was just 3 days before the war began. The timing suggests either extraordinary foresight or privileged information. On 28th of Feb, the Iran war started. Began with the Operation Epic Fury, a joint US-Israeli military operation targeting Iranian nuclear and missile infrastructure. By 26th of March, less than 1 month later, the VLCC spot rates had reached $108,000 per day, representing a 209% increase from pre-war levels of approximately $35,000 per day. Sinokor positioned assets before the conflict, partnered with MSC before the market explosion, and captured extraordinary value when the forecast materialized. Let me summarize the key findings. First, the 33 strategic window. Let me summarize the key findings. First, the 33-day strategic window. Second, the perfect timing of the partnership. Third, the massive returns. Fourth, the dramatic market positioning improvement. Sinokor rose from the 12th largest VLCC owner globally to the 3rd largest, trailing only Bahri and China VLCC. This wasn't organic growth over decades. This was an aggressive acquisition and strategic positioning that transformed the market position in months. Fifth, extraordinary value creation. The $2.5 billion investment in VLCC acquisitions generate unrealized gains of approximately $700 million from the fleet appreciation alone, and each vessel gained roughly $20 million in value over 6 weeks. Combined with operating income and 6-month projected ROI reached 40 to 50%. These findings aren't just impressive numbers. They represent a case study in strategic timing, risk assessment, and value capture that deserves detailed examination. Let me walk through the detailed timeline of events. In late January 2026, Sinokor began positioning 6 empty VLCCs inside the Persian Gulf. Moving on to February, the 25th of Feb, MSC Group, through its subsidiary SAS Lux, filed regulatory documents for the acquisition of a 50% stake in Sinokor Maritime. This filing with antitrust authorities formalized a partnership that had likely been under negotiation for weeks or months. The timing, just 3 days before the war, is striking, but that's just a sort of coincidence because it takes months to process all of that. On the 28th of Feb, the war begins. The sequence is critical. Positioning came first, partnership filing came second, the conflict came third, and the value capture came fourth. Each step built on the previous one. The Persian Gulf positioning decision deserves detailed examination because it represents the single most valuable strategic move that Sinokor made. Critically, these ships were positioned empty. This maximized flexibility. Empty vessels could be used for crude storage, which is what ultimately happened. They could be loaded for transport if opportunities arose, They could be repositioned if conditions changed. Full vessels would have been committed to specific cargoes and destinations. Empty vessels retained optionality. The revenue impact has been extraordinary. These 6 vessels are currently earning $500,000 per day each for crude storage contracts. That's $3 million daily total, or approximately $90 million monthly from just these 6 ships. To put this in perspective, a typical VLCC in normal commercial service might earn $35,000 to $50,000 per day. These vessels are earning 10 times that rate. The positioning decision alone generated enough value to justify the entire strategic thesis. The MSC partnership represents another critical element of Sinokor's strategy. Let me explain the deal structure and strategic implications. The deal structure gives MSC and Sinokor owner Gai-hyun Chung equal 50-50 ownership with joint control of the VLCC fleet and container network. The strategic implications are significant for both parties. For MSC, the world's largest container shipping company, this deal provides instant VLCC capacity during a supply crisis. Rather than building or buying a tanker fleet from scratch, which would take years and billions of dollars, MSC gained immediate access to 35 plus VLCCs and a growing fleet. They also acquired Sinokor's 60-port intra-Asia container network, strengthening their regional presence. For Sinokor, the partnership provides access to MSC's global network, capital resources, and most importantly, the chartering relationships. MSC's scale and financial strength provide the stability and growth capital that a mid-sized Korean ship owner couldn't access independently. Together, the combined entity controls approximately 25% of compliant VLCC spot fleet, giving them a significant pricing power in the market. They are positioned as the world's number 3 VLCC operator now, trailing only Barry and China VLCC. The deal formalized what industry sources had speculated about for months, a behind-the-scenes collaboration between the Ponte family that controls MSC and Gai-hyun Chung, which is the Sinokor owner. The Iran's war impact on shipping markets was immediate and severe. The war began on the 28th of Feb. On the 14th of March, approximately 2 weeks into the conflict, the US forces struck Karg Island, Iran's critical oil export terminal. This was a significant escalation because Karg Island handles the vast majority of Iranian crude oil exports. Disrupting this facility directly impacted the global oil supply and increased demand for alternative shipping agreements. Throughout this period, the Strait of Hormuz tensions remained elevated. The strait, through which approximately 20% of the global oil supply passes, became a focal point for potential Iranian asymmetric retaliation using anti-ship missiles, drones, or naval mines. The market impact was dramatic and immediate. The impact on vessel values was equally significant. 10-year-old VLCCs, which were valued at approximately $85 million before the conflict, jumped to $105 million, $20 million increase per vessel. The market impact exceeded even bullish forecasts. While analysts had predicted rate increases, the magnitude of the surge surprised most observers. This benefited those who had positioned for the risk, like Sinokor, while penalizing those who had ignored the intelligence warnings. The total fleet value increased to over $3.7 billion. This appreciation occurred in just 6 weeks, representing a 28% increase in asset value without any operational changes. The return on investment, the $2.5 billion investment made in late 2025 and early 2026, is projected to generate a 40 to 50% return over 6 months when combining asset appreciation and operating income. To put this in perspective, Sinokor created more value in 6 weeks than most shipping companies create in 5 to 10 years. This is the power of strategic positioning combined with geopolitical catalysts. Sinokor had good intelligence, took calculated risks, collaborated with MSC, and executed flawlessly when the opportunities emerged. Sinocor's VLCCs were built between 2010 and 2016, making them modern, fuel efficient, and compliant with current and anticipated environmental regulations. Older vessels face regulatory pressure, higher operating costs, and potential stranding risk. Sinocor's fleet is positioned for long-term viability. Sinokor acquired 35 of the 45 available VLCCs on the market. The MSC Alliance provides access to global networks, capital resources, chartering relationships, and political connections that could take decades to build independently. Competitors who want to enter the market now face higher vessel prices, higher financing costs, and uncertain rate sustainability. Being first created a huge advantage. Now, what barriers protect this advantage? First, limited VLCC availability. Most available tonnage is already owned. Competitors can't easily acquire fleets. Second, 18 to 24 months new build timeline. Even if competitors order new vessels today, they won't arrive for 2 years. Third, regulatory compliance costs. Meeting environmental regulations requires capital investment and technical expertise. Fourth, capital requirements. $100 million plus per vessel, building a meaningful VLCC fleet requires billions of dollars in capital. These barriers make Sinocor's advantage sustainable for the medium term, even if competitors recognize the opportunity. In value investing terms, like Warren Buffett calls it, this is called creating a moat around your business. Despite the extraordinary success to date, Sinokor faces significant risks that could erode value or even generate losses. Let me explain these risks across 4 categories. First, geopolitical risk. The 6 VLCCs positioned inside the Persian Gulf face the risk of being trapped if the Strait of Hormuz closes due to mining, missile attacks, or some kind of naval blockade. These vessels would be unable to exit, unable to load or discharge, and potentially subject to damage from military action. War escalation could directly damage vessels through missile strikes, drone attacks, or naval mines. Even if the vessels aren't directly hit, the risk of damage affects insurance coverage and charterer willingness. Sanctions on Iranian oil could affect charterers who continue to trade with Iran, creating legal and reputational risks for vessel owners who serve these customers. Second, the market risks. The most significant risk is that the war ends quickly, perhaps through diplomatic breakthroughs or decisive military victory. If the conflict ends in Q2 2026, VLCC rates could collapse from $108,000 per day back towards $40,000 per day or lower. Storage contracts at $500,000 per day would likely be cancelled or renegotiated. Strategic petroleum reserve releases by the United States and other countries could increase supply and reduce the demand for storage. A global recession would reduce oil demand, decreasing the need for crude transportation and storage. Any of these factors could cause rates to fall faster and further than anticipated. Third, operational risks. The MSC partnership, while strategically valuable, creates integration challenges. Combining different corporate cultures, operational systems, and decision-making processes is difficult. Conflicts over strategy, capital allocation, and operational control could emerge. The $2.5 billion acquisition was likely financed with significant debt, creating interest payment obligations and refinancing risk if rates rise or cash flows decline. Insurance costs for vessels operating in war zones are skyrocketing, potentially exceeding budgeted amounts and reducing profitability. Fourth, regulatory risks. The MSC Sinokor joint control filing has triggered antitrust review in Cyprus and potentially the EU. Regulators could block the deal, require divestitures, or impose conditions that reduce its value. Environmental regulations like the carbon intensity indicator and energy efficiency existing ship index are becoming stricter, potentially requiring capital investment or operational restrictions. Sanctions compliance is complex, with multiple overlapping regimes from the UN, US, EU, and other jurisdictions. Violations could result in fines, vessel seizures, or loss of banking relationships. These risks don't mean Sinocor's strategy was wrong, they mean that extraordinary returns come with extraordinary risks. The question is whether Sinokor has adequately identified, priced, and managed these risks. Given the uncertainties and risks, let me present three scenarios that span the range of possible outcomes. This scenario analysis helps understand the risk-reward profile and prepare for different futures. First, the bear case. In this scenario, the war ends in Q2 2026, perhaps through diplomatic breakthroughs or decisive military victory or political pressure. The VLCC rates fall from current levels to approximately $40,000 per day as the risk premium disappears and supply-demand balance normalizes. The storage contracts at $500,000 per day are cancelled or renegotiated at much lower rates as the urgency for floating storage diminishes. Fleet values drop approximately 15% from the current levels as the war premium evaporates. Even in this bear case, Sinokor remains profitable. The fleet appreciation that already occurred is locked in if vessels are held long term. Operating income at $40,000 per day covers costs and generates modest returns. However, the upside is 50% less than currently projected. The 40 to 50% ROI becomes 20 to 25%. This is still a successful outcome, just not the extraordinary result of the base case. Second, the base case. In this scenario, the war continues through 2026 without dramatic escalation or resolution. VLCC rate stabilizes at $80,000 to $100,000 per day, remaining well above pre-war levels but moderating from current peaks. Storage demand remains strong as Iranian exports stay disrupted and traders maintain inventory buffers. Fleet values hold at $100 million plus per vessel as the market recognizes sustained tightness in the VLCC supply. In this scenario, Sinokor achieves a projected 40 to 50% ROI on the $2.5 billion investment. Operating income of approximately $180 million monthly continues generating approximately $2 billion annual revenue. Fleet appreciation of $700 million is realized if the vessels are sold or marked to market. This is the scenario that current positioning appears to anticipate. Third, the bull case. In this scenario, the war expands, perhaps through Iranian closure of the Strait of Hormuz, attacks on Gulf infrastructure, or involvement of additional countries. VLCC rates exceed $150,000 per day as the supply is severely constrained and demand for secure tonnage surges. The 6 vessels positioned inside the Gulf command extreme premiums as the only compliant tonnage available in the region. Fleet values jump to $120 million plus per vessel as scarcity intensifies. In this scenario, Sinokor achieves 100% plus ROI, potentially doubling the $2.5 billion investment. Market dominance is established as the number 2 or even number 1 VLCC operator globally. However, this scenario also carries the highest geopolitical risk, including potential vessel damage, crew safety concerns, and regulatory intervention. The key insight from scenario analysis is that even the bear case remains profitable, while the base and the bull cases generate extraordinary returns. This asymmetric risk-reward profile with limited downside and substantial upside is what makes this strategy compelling, and that's why we are talking about it. This case study offers important lessons for multiple stakeholders. Let me examine the implications for shipping companies, investors, regulators, and MSCs specifically. For shipping companies, the first lesson is that geopolitical intelligence is worth billions of dollars. Sinokor didn't just have good operational management or technical expertise, they had superior geopolitical risk assessment and the willingness to act on it. Investing in intelligence capabilities, whether internal analysts or external consultants, can generate returns that far exceed the cost. The second lesson is that positioning before the crisis creates massive advantage. Waiting until the conflict begins means paying higher prices, facing greater risks, and capturing less value. Early positioning based on probability assessment, not certainty, is the key. Third, strategic partnerships amplify the opportunities. Sinokor's alliance with MSC provided capital, networks, and capabilities that would have taken decades to build independently. Fourth, liquidity matters. Sinokor absorbed 78% of the available VLCC tonnage, preventing competitors from replicating their strategy. When opportunities arise, move decisively to capture available resources. For investors, the first lesson is to watch tanker positioning data as a leading indicator. AIS tracking shows where the vessels are positioned. Unusual concentration and risk areas may signal informed positioning. Second, merger and acquisition filings can signal strategic moves. The MSC Sinokor filing on the 25th of Feb preceded the war by 3 days. Regulatory filings are public. Information can reveal strategic intentions. Third, Middle East tensions typically create tanker bull markets. This is a recurring pattern. Understanding the dynamics allows positioning before catalysts. Fourth, storage plays can be highly profitable when supply disruptions create inventory demand. Floating storage at $500,000 per day exceeds most operational strategies. For regulators, difficult questions arise. First, did anyone have insider knowledge about the timing of the military operations? The precision of the positioning and filing timing raises questions that may warrant an The precision of the positioning and filing timing raises questions that may warrant investigation. Second, market concentration is a concern. The top 3 VLCC operators now control approximately 6% of compliant spot fleet. This concentration raises antitrust and market power concerns. Third, where is the line between war profiteering and smart business? Sinokor didn't cause the war. They assessed the risk and positioned accordingly. But extraordinary profits from conflict raise ethical questions. For MSC, the partnership appears brilliantly timed. They gained entry to the VLCC market at the perfect moment, acquiring a 50% stake just before values doubled or tripled. The stake is now worth 2 to 3 times the filing date value. The question is whether this represents strategic foresight, shared intelligence with Sinokor, or lucky timing. The answer affects how we evaluate the deal and whether similar opportunities exist in the future. These lessons aren't academic, they are practical tools for decision making in geopolitically sensitive industries. Let me conclude with the essential takeaways from these remarkable case studies. In 6 weeks, they created over $1.2 billion in value through fleet appreciation and operating income. Charter rates increased 209%. Sinokor rose from the 12th position to the 3rd position. These aren't just impressive statistics, they represent a textbook case of strategic timing that deserves study and emulation. The strategic question remains, was this brilliant forecasting, superior intelligence, or extraordinary luck? The truth likely combines all 3 elements. Sinokor had access to sophisticated geopolitical risk assessments that identified elevated war probability. They had the intelligence to interpret these signals correctly. They had the courage to act decisively despite uncertainty. And yes, they had some luck that the timing worked out as precisely as it did. But here's what's most important. Regardless of how it happened, the results are real and sustainable. Sinokor and now MSC, through their partnership, has achieved a dominant position in the VLCC sector. They control premium price assets positioned in the right geographical locations. They have a strong partnership that provides capital networks and capabilities for future growth. The bottom line is this: geopolitical risk is not just a threat to be managed. It's an opportunity to be captured by those with the intelligence to assess it, the courage to act on it, and the discipline to execute flawlessly. Sinokor's strategic masterclass demonstrates that extraordinary returns are possible when preparation meets opportunity. The question for all of us is, when the next opportunity arises, will we be prepared to act? As we look ahead, several critical factors will determine whether Sinokor's success continues or faces headwinds. Let me identify the key monitoring points for all stakeholders. First, war duration. The Strait of Hormuz status. The sustainability of elevated VLCC rates depends heavily on how long the conflict continues and whether the Strait of Hormuz remains open. A quick resolution would cause rates to collapse. An extended conflict or strait closure would push rates even higher. Monitor diplomatic developments, military assessments, and Iranian statements for signals about conflict duration. Second, regulatory scrutiny. The MSC-Sinokor partnership faces antitrust review in Cyprus and potentially the EU. Regulators may block the deal, require divestitures, or impose conditions that reduce its value. Monitor regulatory filings, public statements from the competition authorities, and industry lobbying efforts for signals about the likely outcome. The key question is whether this is a temporary spike or a structural shift. Sinokor's next strategy moves. Will they expand the fleet further, take advantage of high rates and strong cash flow? Will they take profits by selling vessels at peak values? Will they invest in new builds or second-hand tonnage? Monitor vessel transactions, financing activities, and management statements for signals about strategic direction. The competitor response. What will Bahri, China VLCC, and other major operators do? Will they attempt to replicate Sinokor's strategy? Will they lobby for regulatory intervention? Will they form competing partnerships? To check this, monitor competitor announcements, fleet transactions, and strategic initiatives for signals about competitive dynamics. Beyond these specific monitoring points, the broader lesson is clear. Intelligence is available. The 2025 forecast identified elevated risk. Market signals confirmed the assessments. Sinokor acted and captured extraordinary value. The next geopolitical catalyst is already developing, whether in the South China Sea, the Black Sea, the Arctic, or elsewhere. The intelligence is available. The question is whether you will act on it. Will you be the next Sinokor, or will you be the competitor who watched from the sidelines? The choice is yours. Thank you for taking the time to see this presentation. I welcome your questions, comments, and perspectives on these issues. Welcome to the presentation on the ATRC Talent Development Program. The talent program has got 5 levels, and the work done inside it is on real customer work. Shares are available in the projects for the participants, and the focus is on serious customers like exporters who export globally. The advantages of this program include getting actual customer work, meeting global compliance requirements, and developing and maintaining supply chains. These are not fake exercises, but real business problems, and you get to learn from live client scenarios. At least 15 to 30-minute mentor and project manager check-ins every week. Senior mentors and project managers are available for guidance and feedback. Direct access to the leadership team of companies and customers. Regular feedback sessions. Since the projects have multiple participants, learn how to work in a team. Other advantages are shares in projects. You get to deliver real stuff that the customers wanted. You are able to demonstrate your work to other potential future employers and clients. Certificates are available for successfully completed trainings within the program. Training is available on the project equity method, which is a spatial system we have designed for tracking of projects. Real ownership in the success of the project you're working on, and a transparent progression criteria. There are some commitments to time and quality that we expect. There is a minimum commitment of 2 hours per day for levels 2 to 5. For level 1, there is no time or quality commitment. It is an evaluation level. We expect all participants to reply to the project manager or mentor within 24 hours if there is any communication. We expect participants to submit quality work on time. We expect participants to self-check the work before submission and meet the requirements to maintain the level that they are in. The other commitments are use the approved procedures, Never promise pricing or deals to customers if you're not in the position to do so. Escalate any kind of uncertainty immediately. Protect ATRC and the customer's data from breaches. The NDA lasts 2 years after exit. As a professional, we do not expect any kind of information related to the customers to be discussed even after the NDA is expired. We expect the participants to represent the company positively all the time. No harassment or discrimination anywhere. Understand that this is more like a business and the equity is speculative. There is no guaranteed compensation unless the project manager creates a task which is paid for separately. Now we shall be discussing the levels and their details. Level 1 is the evaluation level. The objective is to test the capability, aptitude, intelligence, and attitude of the participant. The duration is about 2 to 4 weeks. The location is remote, so we don't expect the participant to actually visit or go anywhere. There is no compensation or payment related to any kind of task in this level. It is designed for skill building and evaluation only. After level 1, participants can move into level 2. Level 2 is the minimally active level. In this level, shares are available in projects. The minimum commitment is 2 hours per day to maintain this level. Projects are usually non-critical customer projects, and all costs related to the project are covered. However, the approval of the project manager is required before any type of cost is incurred. After level 2, there is level 3, which is the active participant level. The minimum commitment in this is 6 hours per day to maintain the level 3. Shares are available in the projects that are participated in. The project types are usually non-critical customer-related projects, but there might be some critical project-related tasks that might be assigned based on the approval of the project manager. The costs related to the projects are covered, and it is based on the approval of the project manager. The level 4 is a project manager. Similarly, shares are available in projects, but the minimum commitment is a bit less. Here it is 4 hours per day. The availability is more strict. It is on demand based on the project requirements. So the project manager has to be available for the project as required by the project. The types of projects are all types of customer projects, whether they are critical or non-critical types of tasks. All costs related to the project are covered. The approval authority of all costs that can be incurred in the project. The project manager has the approval authority on all costs which are incurred in the project that they are managing. There will be maximum 1 project manager on a project at a time. In case a project manager leaves a project, we will be assigning another project manager. Level 5 is that of the program manager. Here they are managing multiple projects, and their task is to monitor the projects and the project managers. They also have shares in the projects that they are managing and monitoring. The minimum commitment is 6 hours per day to maintain this level. The availability requirements are based on the demands of the projects and the programs that they are managing. The types of projects are all types of customer projects. All costs are covered. However, the approval authority on the cost of each project is only with the project manager. The program manager can provide information and guidance on cost planning, which can be incurred inside the project, but the approval authority on all costs is still with the project manager. This was a small description of the ATRC Talent Development Program. If you have any questions, you're welcome to ask. If you are interested in participating in the ATRC Talent Development Program, please send an email to hover@remote-support.space with the subject line Potential Project Participant. Thank you for taking the time to understand this opportunity.